Good evening, everyone. I'm Susie Garrow.
And I'm Bill Griffith. Tyler Matheson is off again this evening. It looks like Dow's 17,000 is going to have to wait another day. Stocks have been on a tear lately, as you know, reaching historic closing highs for both the Dow and the S&P on Friday. But both those averages kicked off the new trading week with some modest declines. Another round of mergers would normally send stocks higher, but not today. And we'll have more on those deals later in the program. At the close, the Dow was down 9 points. The Nasdaq managed to eke out a fractional gain, enough for a fresh 14-year high. And the S&P was down by about a quarter point. Now, even with today's declines, the Dow is just 63 points from the 17,000 mark, rallying about 2% this year. So with a week to go in the first half of this year, Dominic Chu takes a look at the stocks that helped get the Dow to this point and what may lead the next leg.
We hit Dow 16,000 back on November 21st of last year, and a handful of stocks have helped propel the index towards the 17,000 mark. Since then, semiconductor maker Intel has been a star performer. Shares are up 19% during that time frame. Then there's pharmaceutical giant Merck. It's managed a 21% gain since the Dow hit 16,000. And the single best performing stock in the Dow Industrials over that time span has been construction and mining equipment maker Caterpillar. It's up a whopping 34%. Now, the question for many investors is, where will the next round of leadership in the stock market come from?
I think some of the areas that look attractive, for us, are in the technology space. A lot of the next generation technology companies that are focused on cloud and next generation architecture were sold off very hard in March and April. I think also in the consumer discretionary space, some of the mid-cap retailers continue to look attractive to us, as well as some areas of the healthcare space.
Of course, there will always be risks to consider as well, and some of those pertain to the bigger picture economy and even central bank policy.
I think you need to keep your eye on interest rates, and if they're moving too far too fast, that would be probably the beginning of a more substantial correction in the stock market.
Regardless of the risks, it's important for each individual investor to gauge their own appetite for how much they want to take.
What I would say to investors is the thing they should be most concerned about is their own intestinal fortitude. If they have a long enough time horizon, they need to remain committed to stocks if they're going to meet their long-term goals.
The stock market near record highs doesn't mean there aren't still opportunities, but one should definitely be aware of the potential pitfalls when making those decisions. For Nightly Business Report, I'm Dominic Chu.